Hello and welcome to Chapter 9. So in this chapter, we're going to take a look at how companies' finance managers acquire the resources the company needs using available resources and utilize those resources so that the company can make the most profit possible. All right, so in this chapter, we're kind of taking a look at what financial management is. We'll talk about some of the issues financial managers face. We'll talk about some of the tools they use. We'll look at some of the major sources of funds that are available for a company to use. Talk about some of the issues, though, that they get into when they're talking about capital structure. And we'll talk about how they manage current assets, and we'll finish out with a little bit about how financial managers evaluate budgeting proposals. To start this chapter, one thing you may want to do is watch the Urban Farms video that is in the Chapter 9 of the digital book. Normally I don't play those. They're a little bit on the cheesy side, but watching this particular episode will give you guys a good understanding of what financial managers do, at least for a small company example. But finance as a whole is essentially when a company is trying to find the best sources of capital, financial capital, and then the best way to use it. So if you remember back early on in the book, I believe it was Chapter 1, we talked about the fact that capital is actually not money. It is the things that your company uses in order to make their money. So then financial capital is the money you use to buy those things so that you can make money. So a portion of a company's capital is used to fulfill their short-term obligations like their payroll or being able to pay bills to, say, suppliers or partners. Other funds might be used to fund long-term investments like buying a new piece of land or a new plant or an expensive piece of equipment or to launch a new product line. The finance department chooses the best sources of funds for a business, and then it chooses the best method for utilizing those funds. The sources and uses are chosen based on the goals that are set by the financial managers of the company. Okay, we've also talked a lot about, and we'll continue to do so in this course, about social responsibility. Remember back when we were talking about all the different stakeholder groups. For example, in Chapter 8, we talked about suppliers and partners and customers and the government, even the environment, as all being stakeholders. And the thing we pointed out was you can't just think about making money. You have to consider, if you want to be successful long term, you have to consider not only the owners as a stakeholder, but also these other stakeholder groups and think about what they need. Give back is another thing we talked about. Giving back to the community and seeing them as a stakeholder. Well, all of this stuff is great, and we absolutely should do that. Any company that wants to be successful long term, in fact, must do this. However, there's this concept called fiduciary duty that I wanted to point out. It essentially says that when push comes to shove, financial managers want to err on the side of making money. I'm not saying in a way that is illegal or in a way that is unethical. I'm not saying that at all. But when push comes to shove between serving the interests of one of the stakeholder groups and serving the owners by making money, financial managers should err on the side of making money, because when it comes down to it, if the company isn't profitable, it can't stay in business. If it's not in business, it can't help anyone. That's essentially what that concept means. Now let's look at the concept of risk and return. So if you take a look at that graphic that's on this slide, this essentially says that assets that have a very low risk have also a very, you can't make as much money. There's not as much return typically on those types of resources. Whereas your riskier investments, yes, you can make a whole lot of money potentially with them, but they're a lot riskier. When we get into the next chapter, we'll talk about some specific securities that would kind of lie on that risk-return relationship. So with that, for now, let's just keep in mind that there is a trade-off between risk and reward. Financial managers want to earn an attractive rate of return for their shareholders, but they have to kind of keep this risk-return relationship in mind. So the higher the expected return that you're looking for, the more you're exposing the company to risk. In your book, take a look at Exhibit 9.1. It shows a good example of what we're talking about here. It shows a 3-month treasury bill, and it's showing its high and low returns over the course of decades and decades and decades. So looking at 3-month treasury bill, and I will tell you that the lower end of this scale is a lot more realistic typically, but it has earned as much as 14%, that particular investment. Look at the 10-year treasury bonds. Now, those are a little bit more risky, but look at the range. Yes, you can earn quite a bit more, but you've noticed that you can't, it has lost as much as 11%. And then the same thing, pushing it still further, S&P 500 stocks have gained as much as 52%, but have lost as much as 43%. So does that risk-return relationship is something that financial managers definitely have to keep in mind as they're choosing investments for the company. Okay, I also wanted to mention financial ratio analysis. So in the last chapter, we talked about the importance of keeping good books. But imagine if every time you wanted to get a good feel for how the company was doing financially, you had to dig into the financials of the company. You look at the books, the financial statements, for example. Well, financial ratio analysis is used by financial managers to access the company's current strengths and weaknesses in a lot quicker way. So the analysis calculates the ratios that essentially help compare the major accounts listed in the company's balance sheets and income statements. Another thing I pointed out by that second bullet is to be sure that you understand that by themselves, financial ratios aren't really all that useful. They have to be compared to something else, either to other companies like a competitor or to an industry average. That's quite often the way that that's done. So they'll give you some really good ideas about the financial health of the company. Now let's look at some specific ratios. Let's look at liquidity ratios. They measure the company's ability to pay its short-term debt. Remember, current liabilities are those liabilities that are expected to become due within the coming year. Financial current assets, on the other hand, are those assets that are expected to be turned into cash within the next year. So if you want to get kind of a feel for how able the company is to be able to pay its short-term liabilities, then they can simply use the current ratio, which is current assets divided by current liabilities. The larger the current ratio, the easier it is for the company to pay its short-term debts. So A current ratio below 1 signifies that the company doesn't have enough money to pay its short-term liabilities. That is bad. If you take a look at the example in your book, it shows that in January 2017, McDonald's had a current ratio of 1.39, and they compared that to an industry average of 1.54. So this ratio of 1.39 for McDonald's essentially states that McDonald's has 39% more current assets than it does liabilities. The industry average has a stronger liquidity ratio at 54%. But keep that in mind that you can't only look at one financial ratio. It's often useful to look at more than just one ratio. All right, let's look at asset management ratios. One that is used quite often is called, these are actually called activity ratios also. But let's look at one called the inventory turnover ratio. That measures how effectively a company uses its assets to generate net income. So let's take a look at the inventory turnover ratio. That's computed simply by dividing the company's cost of goods sold by average inventory levels. That measures how many times a company's inventory is sold and replaced every year. For example, if a company keeps an average of 100 finished widgets in inventory every month, and it sold 1,000 widgets this year, then it turned its inventory 10 times. That's really important for companies to understand because it shows them how efficiently they're using their inventory to make money. So following that McDonald's example, once again, their inventory turnover ratio was 181. That's a lot stronger than the industry average, which is 67. So in other words, McDonald's carries only a little over 2 days worth of inventory on average compared to the average fast food restaurant, which carries 5.45 days of inventory. So a high turnover ratio is good because it means that you can continue daily operations with a small amount of inventory on hand. I mean, it's expensive to carry unsold inventory, just having it sit there on the shelves. So low inventory turns is a good thing. Companies with high inventory turns, in other words, they can replenish inventory levels more frequently, have less cash tied up in inventory, which means those funds can be used elsewhere. Now, understand though, inventory turnover ratios can be too high. When that happens, a company isn't holding enough inventory to meet demand, which can cause stockouts. You know, like when you get on a website and try to order something, you put it in the basket, and then it says on back order. That frustrates customers, and most likely they're just going to go somewhere else, buy it from one of your competitors. Another asset management ratio I'd like you to look at is average collection period. That's computed by dividing accounts receivable. Remember, that's the total amount of what people owe you, divided by average daily credit sales. In other words, the amount of items you sell on credit. So a value of 45 for this ratio would mean that customers on average take 45 days to pay for their credit purchases. In general, the smaller the ratio, the better, since having a lower value indicates your company's customers are paying for their purchases more quickly. Leverage ratios are also important. They measure the extent to which your company is using debt to make money. So while the use of leverage can benefit you when times are good, a high degree of leverage can be really risky. Let's think about that for a moment. if you're using debt, you get a bank loan, for example, to finance a piece of equipment. Look, you can probably get some pretty good interest rate, and you can get somewhat flexible terms. But you know what? You still got to make regular payments. So when times are good, that's fine. But when times are bad, that can be really tough to handle. So your debt ratio is computed by dividing total liabilities by your total assets. So if a company financed half of its assets with debt and half with owner's equity, say, then the debt ratio would be 50%. The higher the debt to asset ratio, the more highly leveraged the company is said to be. Now, following our McDonald's example, McDonald's debt to ratio or debt to asset ratio was 83.7% compared to Starbucks ratio of 25%. So that shows you that McDonald's is leveraged nearly, over 3 times more with debt than Starbucks is. Now that sounds really bad, but let's take a look at their profitability ratio. So a profitability ratio is another ratio I would look at. Let's look at return on equity. That's one. That's calculated by saying net income or profit divided by your owner's equity. That means that the income earned per dollar invested by the stockholders that's what that gives you. So looking at the McDonald's example, look at McDonald's. Their ROE was really strong at 192%. And then look at the industry average, not quite 25%. In other words, a dollar invested in McDonald's produces a much larger return to shareholders than the fast food industry does on average. So they have a lot of debt, as we saw in the last ratio, but return on equity, profitability-wise, shows they're using it. They're using their debt very efficiently. Another profitability ratio I'll leave you with is earnings per share, and that simply indicates how much net income a company can earn per share of its common stock. So it's simply you take your net income, you subtract preferred dividends because you're subtracting that amount out, and then dividing that by the average number of common stock outstanding. And outstanding simply means that's out there in circulation. It's not any common stock that's been retired yet, been repurchased and then not retired. So net income minus preferred dividends divided by common stock gives you earnings per share. So again, McDonald's earnings per share was 5.44. If you compare that to Starbucks, their earnings per share was only 1.90. So that tells you that McDonald's is earning greater net income per share of stock than Starbucks is. All right, on the next slide, that's in your book, all the financial ratios that you need for the upcoming exams. But if you have the digital book only, you may have noticed it's hard to see that entire thing. All of those ratios on one convenient sheet. So I used a snippet tool and tricked it so that I could put it all in one sheet. Definitely print this slide out before you take the next exam. That'll be a real great cheat sheet for you coming up. Okay, so let's look at some basic planning tools. Financial managers receive a lot of information from the budgeting process, and that's really essential for financial planning. So they use these tools called pro forma financial statements, which are essentially guesses at what the financial statements will look like based on a company's various budgets. So You'll develop a budgeted income statement and a budgeted balance sheet. So budgeted income statement, obviously that shows you how a company's budgeted sales and costs is going to affect net income. And then your balance sheet forecasts the types and amounts of assets the company is going to need to implement in its future. And then how you're going to finance those things. These two statements, by the way, they help you evaluate the impact of your plans when it really comes down to it. You also have then, like we have the big three from the last chapter, right? Your balance sheet, your income statement, and your statement of cash flows or cash flow statement. Well, the cash flow statement in this sense would be a cash budget. It's essentially a forecast of the projected cash inflows and outflows. So it's like a forecasted bank statement like you would use. When you get your bank statement at the end of each month from your bank, shows you the money coming in and out. So this is essentially what businesses use to forecast money coming in and out, but also the timing of those cash flows. So they can be sure that they're going to be able to meet their needs as far as cash goes. Because, a lot of times companies will experience uneven inflows and outflows in cash over the course of the years. Well, if you've got things that are due at certain times of the year that you have to pay out, well, it'd be important for you to be able to kind of get a good idea of the timing of the money you've got coming in and out and how to best manage those inflows and outflows. All right, let's look at some of the sources of financing that's available to businesses. Remember, we've talked in the past about trade credit. That's that type when you buy inventory or supplies on credit from, say, another business to that could be inventory that you use to resell or supplies that you use to make your money. So trade credit is simply that process of buying something on credit. So in invoicing terminology, just want to kind of let you understand how they do this. Trade credit might, on an invoice, might say 2% 10, net 30, which means customers can pay 2% than the invoice amount if they pay within 10 days. Now, if they pay between 11 and 30 days, then they have to pay the entire amount that is due. So the 30 is saying payment after 30 days is late. You got to pay us everything you owe us within 30 days. So trade credit is a type of short-term financing, also called spontaneous financing. Also wanted to make sure that you're aware of this practice called factoring. Factoring means that you go to a financial intermediary called a factor. They offer short-term loans in the amount of your company's accounts receivable until you actually can get paid by your customers. So you'll typically want to do this when you're running a little short and need to make payroll or meet some other payment. It's like loaning a friend $20 until you get paid on Friday, right? But in this case, you'd expect a little interest. So suppliers usually include the terms of trade credits in their invoices. Small companies in particular depend on this type of financing. A company that uses factoring doesn't have to wait for their customers to pay, as the payment is made almost immediately by the factor. Cool thing about using a factor also is that, yes, you're paying a fee for this convenience. Factors don't do this out of the kindness of their heart, but they assume the credit risk of any of your customers not paying you. So that's kind of cool. and you don't have to worry about doing collections. Hey, if they buy your accounts receivable from you, if somebody doesn't pay or they're paying late, they have to deal with it. You don't have to deal with it. So that can be a pretty cool deal for you as well. Some other types of financing, as you hopefully saw in the Urban Farms video, you can get a line of credit. That's simply an arrangement by a bank that pre-approves a credit limit up to a specified amount, kind of like a credit card, using a credit card, but it's got usually better interest rates and more flexible lines of credit. Now, something that is very similar is the use of a revolving credit agreement. Essentially, that's a guaranteed line of credit. But there's a catch. The catch is you are promising the bank the bank is promising you that, say, if your line of credit, this guaranteed line of credit, was up to $100,000 for the coming year. Yeah, that's great. That is the bank is committing to have that money available for you to borrow. No covenants. You can just borrow it at any time during the year. But the catch is for any funds that you don't borrow, you have to pay them a fee on. So let's say that you get a revolving credit agreement for $100,000 for the coming year, but you only wind up borrowing 90% of it, then you're going to pay a commitment fee on the remaining $10,000 that you did not borrow. Now, it's not going to be the same interest payment rate, most likely, as the amount that you did borrow, but essentially, the bank, hey, they set aside $100,000 for you to use, and they promised you could use it without any stipulations, but, you're paying them a little something for that convenience. Commercial paper, in essence, is an IOU. These are usually issued by large corporations in exchange for a small amount of interest. So let's say that a corporation needed $1 million. They needed $1 million. Look, the interest rate that you're going to get off this isn't a whole lot of money. And they usually only make these arrangements with wealthy investors or an institutional investor. But let's say that a company needs $1 million and you're a wealthy investor, you've got $1 million. Essentially, you are going to buy the IOU at a premium, or at a discount rather, and they're going to pay you a little bit of interest on that. So an average is maybe the average rate for, say, a 30-day piece of commercial paper is like 0.63%. That means a company would pay only $6,300 in interest for using $1 million for 30 days. But because it's sold at a discount, the interest cost is deducted up front. In other words, the company would get $993,600 or $700 for 30 days, after which it would have to pay back the full $1 million. So again, these are usually purchased by institutional investors or wealthy investors because commercial paper is typically offered in $100,000 chunks, and this is only usually used by corporations with really good credit ratings because they're also usually unsecured. In other words, there's no assets tied to these loans as collateral. All right, let's look at some longer-term financing. Longer-term financing would be like borrowing, getting a bank loan, or issuing bonds. That is longer term. Some examples I put on the slides there for you, like selling new stock. That's longer term because I mean, at some point you could buy back that stock from shareholders, but it's considered a long-term secure or a long-term form of debt because you're typically not going to have a quick turnaround on that. If you're going to the trouble of selling shares of ownership in your company, you're not going to be able to pay it back anytime soon. You're going to be using that money to finance the growth of your company. So until you get your money on a return for that money, you're not going to be looking to buy that money, but those shares back. And issuing bonds are very long term. Essentially, the way bonds work, you might sell a $1,000 bond. Those are typically, it's like a long-term IOU. If you sold a $1,000 bond for 10 years, you are promising to make interest payments on that bond every year or semi-annually until that bond matures in 10 years. So at the maturity date in 10 years, between now and that 10-year maturity date, you've been making regular interest payment to the person who bought the $1,000 bond from you. And then at the end, at maturity date, you pay them their $1,000 back. So they get they loaned you $1,000, but you paid them, as the company, paid them interest every year or every 6 months throughout the 10-year term. So again, those are usually very long term, 10 to 30 years. I've even heard of companies selling 100-year terms, bonds. I mean, I think that's crazy, but hey, they do it. Okay. Let's also take a look at term loans. I think we're all familiar with those. Won't spend a lot of time here. That's like the type of loans that you and I would get. A car loan is bought with a term loan because you have a regular schedule of very fixed sum payments. We buy a vehicle, we make a car payment at say $300, whatever it may be, every single month. So a term loan for a company would work the same way. Now, the catch with term loans is they're usually subject to covenants. Like a bank might say, okay, look, we'll loan you this money, but we're going to put in covenants that say that you must keep your credit rating at this amount, or we're going to raise your interest rate, because they're taking on risk loaning you money. So covenants is not something that you like. It might accelerate your payments if you don't meet their covenant stipulations. You might not be able to borrow additional money. All bad things. Okay, so corporate bonds are definitely a source of long-term bonds. Long-term financing. I don't know why that's in two different slides, so we'll move on. All right, let's take a look at equity versus debt financing. So debt financing, remember, that's from people outside of the company, creditors. Then equity financing is when you're using funds from the owners. So for a non-corporation, that could just be money from the owner's bank account. For a corporation, that would be money from selling shares of stock, for example. So the balance of how much of your financing is coming from financing and how much is coming from equity is called capital structure. That just describes that mix. Okay, so there are pros and cons from slanting that one direction versus the other. So let's take a look at the advantages advantages and disadvantages of using the first part, using debt. So on the one hand, interest payments are tax deductible. That's pretty cool. Now, I will tell you that since 2018, when we lowered corporate tax rates were lowered from 35% to 21%, the amount of interest that you can deduct from a company's taxes isn't near as high, but you still get a deduction on interest, so that's pretty cool. Another advantage is that companies can acquire additional funds without requiring existing stockholders to invest more of their own money or sell additional shares of stock to investors. That's a giant pain. Now, on the negative side, you do have to make fixed payments, whether times are good or bad. You have to make fixed payments. Creditors also the deal with covenants. That can definitely be a downside. Covenants on using debt financing. Now, when you use equity financing, usually that's obviously a lot more flexible, right? Because you don't have to make dividend payments. Remember, any type of stock, whether it's common or preferred, corporations are under no legal requirement to make dividend payments. So it's definitely less risky in that case. And when times are tough, companies quite often will retain their earnings to save some money. And then also, you don't have to make those regular payments. Now, on the downside, though, you don't get the tax advantages, and you'd have to go back to your existing shareholders if you want to offer new shares of stock and get their permission, go to the board of directors. That giant pain in the butt. So you have to go through that if that's something that you want to use for additional shares of stock. Plus, you don't get the tax advantages that I mentioned a second ago. All right, so just to kind of sum up some of these principles, financial leverage magnifies your return on your stockholders' investment, but only when times are good. It reduces the return to stockholders when times are bad. And so for a lot of companies, the required interest and principal payments on debt can really become a burden for the company. Some companies, in fact, may deleverage. I put this on the slide just to kind of illustrate the fact that, kind of like you and I might do when we're having trouble paying all our bills, one of the things we can do as a strategy is to try to reduce our expenses. Well, companies are no different. They'll try to reduce expenses, and at some point, they may want to switch from using debt to using more equity. So they might sell additional shares of stock to get money to pay off some of the things that they financed with creditors. All right, I'm not going to spend a lot of time on Dodd-Frank. We talked about this already when we talked about the financial crisis of 2008. But in every chapter, we typically talk about a law or two. This one is apropos for the finance industry, since Dodd-Frank Act that came out 2008 essentially put some safeguards in place to limit some of the risky behavior that led to the financial crisis 2008. One thing I will point out, though, is it's very controversial. Some people think that it went way too far, and of course that's mostly people in the business and especially the financial sectors. So they went too far, whereas other people say no, didn't go far enough. Just know that is essentially, hopefully, going to prevent some of the risks that led to that particular catastrophe. All right, so a company can hold on to too much cash. Is that possible? if a company can hold on too much cash, well, technically that is possible. Because, I mean, you got to hold enough cash to be able to pay for the unexpected, sure. But on the other hand, if you hold too much cash, shareholders are probably going to ask why you aren't either paying that money out as dividends or using it to buy assets that can make the company more money. Okay? So also remember that cash equivalent that includes currency, yes, but it also includes money in your demand deposit accounts, like your checking and savings. And there's also cash equivalents. So those are financial instruments like U.S. Treasury bills and money market mutual funds that can be, and commercial paper, that can be converted into cash very, very quickly. Now, T-bills are usually very short term with maturity periods like 4 weeks, 13 weeks, or 26 weeks. They're actively traded on the secondary markets. In other words, their owners can sell them to other investors before they mature. So you can say that they are highly liquid. And then money market mutual funds, that's just a mutual fund that pools funds from a lot of different investors and uses those funds to purchase very safe and very highly liquid securities. So these are also often used by small investors who aren't quite ready to make an investment, or they're anticipating a near-term cash outlay. It just gives them an extra bit of interest over some of the other short-term investments. So how do you manage your current assets, like your accounts receivable and your inventories? So remember, when you're talking about remember we went over invoicing earlier, and taking a look at your ratio that tells you how quickly your customers are paying you when they buy from you on credit. Well, you might determine from that analysis that your customers are taking too long to pay you. And because of that, you're having cash flow problems. You're not able to pay your bills. Well, that's a tricky deal, though. So on the one hand, if your credit terms are too loose, well, yeah, you might sell a lot of product. You might entice a lot of customers to buy your products, but because they're so loose, you might have people that really shouldn't be getting that credit because they don't pay their bills on time. So you might need to tighten your credit standards. That's one thing that you can do, is tighten your credit standards. But if you don't want to tighten them too much, because then you limit your customer base, right? So another thing that you can do to kind of manage your accounts receivable is you can provide those carrots, to those enticements, like giving a discount so that your customers would be inclined to pay a little more quickly. Now, the example that I gave you earlier, in fact, was 2% 10, meaning if you pay within 10 days, you get a 2% discount. 2% doesn't sound like a whole lot, but if your company spends hundreds of thousands of dollars a month on supplies and inventory, man, that can add up quickly. If you can pay 2% less, right? So you can extend the same type of thing to your own customers. You can offer them enticements to pay you quicker, and that will often help with your cash flow problems. All right. Let's take a look at capital budgeting. Now remember, capital is the stuff that you use to make your money. So during capital budgeting, a company is evaluating proposals from your managers related to buying resources that will help them make money for the company. So that might be, you might get a proposal to replace an old piece of machinery or buy some brand new whiz-bang new piece of equipment that'll help you make a lot more product a lot more quickly and more efficiently. It could be buying a new plant, new vehicles, that sort of thing. So financial managers will use cash flow analysis to look at the benefits of long-term investment proposals from managers of the company. So how do they do this analysis? Well, for one, they can consider that risk-return relationship, that trade-off that we talked about earlier. They can also take a look at the time value of money. That really has to be taken into account by financial managers when they need to compare different cash flows that take place at different times. So they'll do this because, think about it, a dollar received today is worth more than a dollar received later, because the sooner you get a dollar, the sooner you can put it to work earning you more money, either as a revenue generating asset or as part of an investment that earns interest. So financial managers will compute net present value to evaluate capital budgeting proposals. Remember this, if net present value is positive, that means that the present value of the expected cash flow from a project is said to be more than the cost of the project. So let's look at these two terms I just mentioned. Present value and net present value. So because money has a time value, a cash flows, value, there we go, depends not only on the amount of cash received, but also on when it is received. So financial managers have to compare cash flows occurring at different times by converting them to their present values. The most common method for doing this is called net present value. So financial managers would reject proposals with negative net present values. So let's watch the videos on the next two slides, and we'll really walk you through the process of calculating net present value. I also created this slide. It has Exhibit 9.5 on there for you, which kind of walks you through a really simple present value example. Again, make sure you watch these videos. If you take a look I got these videos from Investopedia. So if you need even more explanation, go to Investopedia, take a look do a search for net present value, and they'll walk you through several examples there. So for this upcoming exam, make sure you're familiar with all of these key terms and know how they fit in. Also, be sure to read back through each of the chapters, read one section, stop, think about what you've read, ask yourself some questions on what you just read. Make sure you can answer the questions that you asked yourself. Doing that forces yourself into a deeper level of thinking, which will help you remember the information and make better practical use out of it, and will help you do better on the exam. Okay, that's all we have for Chapter 9.